You have heard the buzz. BlackRock is buying Bitcoin, Wall Street just went crypto. Crypto ETFs are the future of investing. On every financial news site, from Wall Street veterans to Gen Z investors on TikTok. But what does that even mean? Why is everyone from hedge fund billionaires to your cousin who trades on Robinhood has suddenly become obsessed with crypto ETFs? And more importantly, are they the keys crypto's next big boom or just Wall Street's latest cash grab? In this video, we are breaking down the truth about crypto ETFs, what they are, how they work, and why they might be the bridge that takes crypto from the fringe to the mainstream. Stage number 1. What is a crypto ETF and why it is a big deal? Let's start simple. ETF stands for Exchange Traded Fund, a collection of assets that you can trade on the stock market like a regular stock. It's a basket of assets like stocks, bonds, or commodities that you can buy and sell on the stock market just like a regular stock. For decades, ETFs have been the go-to investment vehicle for everything, from gold to oil, from the S&P 500 to the emerging markets. There are ETFs for literally everything. There is, let's say, an S&P 500, there is an ETF for tech stocks, there are even ETFs for gold and silver. But if you want exposure to maybe Bitcoin or Ethereum, without the hassle of creating a crypto wallet, managing private keys, or worrying about getting hacked, that is where crypto ETFs come in. A crypto ETF is like a digital shortcut. Instead of buying Bitcoin directly, you can buy a share of an ETF that tracks Bitcoin's price. The ETF handles all the messy stuff, whether it's storage, security, compliance, while you just click buy in your brokerage account. It's an ETF designed to track the price of cryptocurrencies like Bitcoin or Ethereum. Instead of buying Bitcoin directly, dealing with private keys, wallets, or hacks, you just buy a share of the ETF on the NYSE or NASDAQ. It's crypto without the chaos. Think of it like this. You want exposure to gold, you can either buy gold bars or just buy shares of a gold ETF like GLD. Crypto ETFs do the same for Bitcoin and Ethereum. Why does this matter? Because it opens up the floodgates for traditional investors. Financial advisors can now legally recommend Bitcoin exposure. In the US, retirement accounts like 401ks can hold crypto ETFs. And big institutional players, pension funds, hedge funds, finally have a regulated Wall Street approved way to invest in crypto. But with ETF, crypto suddenly looks normal. It trades on regulated exchanges, it fits into retirement accounts, it's something financial advisors can now recommend without sweating over compliance. And that is why the launch of the first US approved Bitcoin ETF in January 2024 was considered a historic moment. Now this isn't just a technical upgrade, it's a cultural shift. Stage 2. Bitcoin ETF, the game changer. For years, crypto enthusiasts begged regulators like the SEC to approve a Bitcoin ETF. The answer was always no. But why? They claimed that the crypto market was too wild, too easy to manipulate, and too unregulated. But in 2023, everything changed. BlackRock filed for a spot Bitcoin ETF. When the world's largest asset manager, which handles over $9 trillion, files for a spot Bitcoin ETF, regulators start paying attention. When BlackRock knocks on the SEC's door, the SEC answers. By January 2024, the US approved 11 Bitcoin spot ETFs. Names like BlackRock, Fidelity, the ARK, Invest suddenly had their own crypto products trading on the New York Stock Exchange. And the results? Insane. Within just 6 months, Bitcoin's ETFs raked in over $60 billion in assets. BlackRock's IBIT ETF became one of the fastest growing ETFs in the history, and Bitcoin, it shot past $73,000 in 2024, smashing its old all-time highs. The impact on Bitcoin's price was so much that it skyrocketed, hitting the new all-time highs above $73,000, fueled by ETF demand. But here's the kicker. Bitcoin ETF didn't just jump into the price. They legitimized crypto. When giants like BlackRock and Fidelity are selling Bitcoin ETFs, suddenly crypto isn't just an experiment or a scam, it's a mainstream asset class. The Ethereum move. After Bitcoin ETFs, the next logical step was Ethereum. In mid-2024, multiple Ethereum spot ETFs launched, and for investors, this wasn't just another crypto coin. But what was the difference then? Ethereum isn't just digital gold. It powers smart contracts, DeFi, and NFTs. So an Ethereum ETF gives investors exposure not just to a currency, but to an entire ecosystem of blockchain innovation. Analysts predicted that Ethereum's ETF could bring in $20 to $30 billion of inflows in the first year, especially if institutions were to bet on Ethereum as a tech play, similar to Web3 infrastructure. Now coming to stage 3, why do crypto ETFs matter? So why is this such a game changer? Because number one, it legitimizes crypto. When names like BlackRock and Fidelity are offering Bitcoin ETFs, crypto is no longer the underground internet experiments, it's a proper asset class. Just like stocks, just like bonds, and just like gold. And that's the point. Bitcoin is being now compared to gold more than ever. In fact, Bitcoin is now called digital gold. Remember when gold ETFs launched in 2004? Gold prices tripled in less than a decade. Many believe that Bitcoin ETFs could do the same thing for crypto. Stage 4, the future potential. Now let's talk about what is next. Number 1, Wall Street adoption at scale. ETFs make it very easy for institutions to go all in on crypto. Pension funds, hedge funds, endowments, even retirement accounts will quietly now start holding Bitcoin. A 1% allocation from global pension funds could mean hundreds of billions flowing into crypto markets. Number 2, more crypto ETFs are now coming. We're not just stopping at Bitcoin and Ethereum. Now imagine this. DeFi ETFs covering tokens like Aave and Uniswap. Metaverse ETFs tracking projects like Decentraland or Sandbox. Blockchain infrastructure ETFs betting on layer 1 and layer 2 solutions. Crypto ETFs could very well soon cover sectors of the blockchain industry, just like how tech ETFs cover Apple, Microsoft and Amazon. Now here's the big question. Are crypto ETFs just like a hype cycle, or are they truly the future of crypto investing? Now let's not get blindsided by the hype. Number 1, the bullish case for crypto ETFs. Now, institutional adoption at scale, like I said, makes it easily now be part of pension funds, 401k, retirement plans, and robo-advisors can all integrate Bitcoin or Ethereum ETFs without touching an actual blockchain. Mainstream legitimacy. ETFs are regulated, transparent, and backed by trusted custodians like Coinbase custody. This reduces the fear of scams or rag pulls. The gold 2.0 narrative. Just like gold ETFs in the 2000s sparked a massive bull run for gold for crypto growth, the similar can actually happen for crypto growth. The risk and controversies. But let's be real, it's not all sunshine and moonshots. Now let's talk about centralized risk. One of the crypto's core value is decentralization, but ETFs are run by centralized giants like BlackRock. If 70% Bitcoin is held by ETFs, is Bitcoin still decentralized? Number 2, regulatory shocks. Governments can still change the rules overnight. A sudden tax crackdown or ETF ban could shake the markets. Number 3, tracking errors and fees. While ETFs are convenient, they may not perfectly track spot crypto prices, plus you're paying a management fee instead of holding assets directly. Reduce self-custody. Crypto pursuits argue that not your keys, not your coins, ETF holders don't truly own the underlying Bitcoin, it's just a financial derivative. So what will the next 5 years look like? Analysts predict that by 2030, crypto ETFs could hold over $500 billion in assets globally if adoption trends continue. That would put Bitcoin ETFs in the same league as the largest commodity ETFs like gold. If that happens, Bitcoin's market cap could pass $5 trillion, especially if global pension funds in US allocate just 1 to 2% crypto exposure, making it one of the largest asset classes in the world. ETFs are also like a Trojan horse. They bring crypto into the mainstream, like I said earlier, into retirement accounts, wealth management portfolios, whether people realize it or not. But what's the biggest story? Crypto ETFs could very well blur the line between traditional finance and decentralized finance. Imagine a future where your retirement accounts holds Bitcoin, Ethereum, tokenized assets side by side with stocks and bonds. This is not a sci-fi dream, it's already starting now. Imagine your portfolio in 2028 where 50% is mutual funds, 30% is maybe real estate, 5% debt and 5% crypto exposure all through ETFs. That future is already taking shape. Crypto ETFs are more than just another Wall Street product. They are a gateway, a bridge for billions of dollars of institutional capital to flow into crypto, a tool that makes Bitcoin as easy to buy as Apple stock, a vote of confidence that crypto is here to stay, a way for billions of dollars to flow into Bitcoin, Ethereum and beyond without the friction, fear or complexity that scared investors away for years. Now, will ETF kill the rebellious spirit of crypto? Maybe. Or maybe they'll just supercharge adoption faster than anyone thought possible. Either way, the future of crypto is no longer being decided in underground forums. It is now being built on Wall Street, trading floors, inside BlackRock boardrooms, and in your own retirement account. So the next time someone says crypto is dead, just tell him this. So was gold until ETFs made it shine again. So if you want to be the part of the growing crypto ETF ecosystem, and you are wondering how can you get exposure, then Appreciate is here for you as a platform which is meant for global investing. And you can invest by just one click and you can access these ETFs in the United States just sitting here in India. Thank you so much.
Investment in securities market are subject to market risks. Read all the related documents carefully before investing.